After Agree Realty Corporation started paying dividends monthly back in 2021, people almost immediately started comparing them to Realty Income. Because the truth is, both of these companies have a lot of similarities to each other in terms of how they conduct their business. They both own very similar property types, and they both had their IPOs back in 1994, which makes it easy for us to compare both stocks to each other in terms of total return. So in today's video, at the request of someone over on our Patreon, we're going to compare both Agree Realty Corporation and Realty Income and determine which stock would be the better choice for dividend investors. So with that being said, let's go ahead and get started. First off, Agree Realty Corporation describes themselves as a real estate investment trust that's rethinking retail through the acquisition and development of properties net leased to industry-leading, omni-channel retail tenants. Agree Realty leverages their three distinct investment platforms to target industry-leading retailers in e-commerce and recession-resistant sectors. Having been founded back in 1971, the company became a REIT in 1994, and today they're one of the largest equity REITs. Agree Realty is an $8 billion industry leader in the acquisition and development of properties net leased to the foremost retailers in the United States. Realty Income has for more than 50 years been on a mission to provide stockholders with dependable monthly income and favorable long-term risk-adjusted returns. They're a real estate investment trust that focuses on the acquisition of freestanding, single-unit commercial properties leased to high-quality tenants under long-term net lease agreements, typically in excess of 10 years. They're a triple net lease REIT, meaning that they pass on the responsibility of paying taxes, maintenance, insurance, and other expenses onto the tenants themselves of their properties. Realty Income was launched back in 1969, and they had their IPO on the New York Stock Exchange in 1994, the same year as ADC did. We'll start by comparing some different metrics, starting with their property portfolios. All this information is coming from their most recent investor presentations on their websites. When it comes to size, there really is no competition. Realty Income, as of the third quarter of this year, has 13,282 commercial real estate properties in all 50 states, as well as Puerto Rico, Ireland, Italy, Spain, and the UK. They collect around $3.9 billion per year in rent from all their tenants, and they have a 98.8% occupancy rating across all their properties. Agree Realty currently has only 2,084 properties with no international exposure. Although Realty Income's occupancy rating is great, Agree Realty is currently beating them with a 99.7% occupancy rating across their properties. If we look at what kinds of properties both companies hold, you'll see that there's a lot of similarities going on. Realty Income currently holds a lot of retail pharmacies like Walgreens and CVS, dollar stores like Dollar General and Family Dollar, as well as convenience stores like 7-Eleven. They also hold some gyms, Walmarts, restaurants, and some other odds and ends. Agree's portfolio currently holds a lot of retail pharmacies, dollar stores, Walmarts, convenience stores, and restaurants, so you can see there's a lot of overlap in terms of the tenants that both companies have. They both hold a lot of the exact same brands as each other, and I'd imagine that in their bid to acquire more properties, I wouldn't be surprised if both Realty Income and Agree Realty have potentially battled each other for acquisitions in the past. But both of these companies target these kinds of businesses for the same reason. The majority of them are more e-commerce and recession-proof. If we go back to Realty Income's largest tenants, how many do you think would seriously suffer in a recession? People are still going to need health products and their prescriptions, so CVS and Walgreens would suffer much less. The dollar stores do extremely well during recessions, so these typically don't close during these times. Convenience stores are something that are also still going to be needed for people who need something really quick. Supermarkets, wholesale, and warehouse club retail stores are also going to fare much better. Restaurants, gyms, and theaters will potentially suffer harder, but they don't make up a large part of their portfolio. Also note how many of these companies are e-commerce resistant. People who go to pharmacies usually can't wait for an online order to arrive. Dollar stores are usually in low-income areas, which helps make them e-commerce resistant because people don't want to pay for shipping and handling when they could just walk to the store. Not to mention, sometimes these dollar stores sell their own brands which are much cheaper. There's no e-commerce alternative to gyms with the exception of home workout equipment, which is expensive. So these kinds of properties are great candidates for REITs to hold in their portfolios. As we've seen, their businesses and portfolios are similar, but where things get interesting is their performance. If we compare both Realty Income's 10-year performance with Agree Realty's 10-year performance using a DRIP calculator, which gives us the total return of a dividend-paying stock with distributions being reinvested, we can see that for several years, Realty Income has been trailing behind. In the last decade, O has provided an average annual return of 8.94%, which is pretty decent, but it doesn't even come close to Agree Realty's performance, which has provided investors an average annual return of 12.69% over the exact same time. So for many years, ADC has just been the better performing stock. If we compare their dividend growth, Agree Realty has also been the better performer in this area too. According to Seeking Alpha, Realty Income currently has a 5-year dividend growth rate of 3.67%. 5 years ago, their stock was paying 21.9 cents per month, whereas today it's now paying 25.6 cents, an increase of only 3.7 cents. Agree, on the other hand, was paying 52 cents per share per quarter 5 years ago. Dividing that by 3, that comes out to 17.3 cents a month. Today, their stock pays 24.7 cents per share. This gives their stock a 5-year dividend growth rate of 6.54%, much better than what Realty Income's provided over that exact same time. We can also see that this year, ADC has just been a better performer from a share price perspective. They've done much better with interest rates being so high compared to Realty Income. So what explains Agree's surge over the last few years and Realty Income's lackluster performance? There's a few things going on, specifically with Realty Income, which helps explain why they haven't been performing as good. In just the past couple years, this company has been extremely aggressive in acquiring properties and growing their portfolio. We saw that back in 2021 when they acquired VEREIT, which was another REIT that held about 3,800 properties in their portfolio. At the time, Realty Income had over 6,500 properties under ownership in their portfolio, so it was a huge amount of growth for them. Realty Income would later spin off VEREIT's office properties, but the company would again go on to acquire another REIT, which was Spirit Realty a couple months ago. This acquisition added an additional 2,064 properties to Realty's portfolio. So with this company's portfolio growing significantly in just the last 3 years, it's worth asking why hasn't that translated into better share price performance? If they're a much bigger company today, wouldn't that reflect in the share price? Well, the answer to that question is no, not yet. And the reason for that has to do with how Realty Income has been acquiring these properties. With interest rates currently being so high, in order to make these big transactions, it doesn't make sense to take out debt for it. Because of interest rates, if Realty Income took out debt to buy these properties, it would lead to a substantial amount of interest rate expense for the company. So borrowing money to acquire these other REITs wouldn't make a lot of good business sense. So what Realty Income has been doing instead is issuing a ton of new shares of their own stock to pay for the new properties. This has resulted in shareholders like myself being diluted. This is the decrease in existing shareholders' ownership percentage of a company as a result of the company issuing new equity. New equity increases the total shares outstanding, which has a dilutive effect on the ownership percentage of existing shareholders. Basically, when new shares are created, all existing shares have less value and the share price goes down. I've criticized Realty Income for doing this in the past, but they've been doing it more often ever since interest rates started increasing. I do wish they'd tone it down with the intense property acquisitions, but I do trust that the management team wouldn't be making these acquisitions had they felt like they weren't getting a good deal on them though. Agree Realty, on the other hand, hasn't been nearly as aggressive in growing their portfolio. They've been much more conservative in our high interest rate environment. So what does this mean for both companies? Both have some advantages that the other company doesn't have. Realty Income's size does help in terms of diversification. They also have international exposure, which helps in that area as well. Agree Realty, on the other hand, has a more conservative real estate portfolio in my opinion. Recently, Realty Income has been making larger bets on sectors that are riskier and they have no prior experience in. For example, they acquired the Wynn Resort Las Vegas a couple years ago, and this single holding now makes up 2.6% of their entire portfolio. That's a huge investment in just one property in a sector that's not recession-proof. They've also invested in vertical farming, which is a new sector that's still uncertain as to how successful it'll be. Agree Realty hasn't really ventured out of their typical conservative acquisition strategy. So in terms of safety, I might be more tempted to say that ADC has the advantage in this category. There's two things, though, that dividend investors should consider. First is that although Agree Realty has been pulling out ahead in the last few years, Realty Income is still the better performing investment since their IPO. In fact, for the longest time, they were doing quite a bit better until just recently. Second, Realty Income has the better dividend track record. ADC did suffer a sizable dividend cut back in 2011. Although it was a while ago, it'll still be a long time before they can potentially be a dividend aristocrat like Realty Income is. While I think both investments are great considerations, for me personally, I'm betting on Realty Income's acquisitions paying off as soon as interest rates get cut. When the economy improves, I think their now larger portfolio is going to better reflect in their share price. But the biggest issue for them is still being too aggressive in acquiring new properties by offering more shares. Once rates get cut, then I'm betting management won't be so aggressive in issuing new shares, and that'll result in more share price growth for their stock. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.